internal control is, and let's just go into a bit more in depth about control procedures. So an internal control is the organizational plan and all the measures that the organization takes to safeguard its assets. Internal controls hopefully also encourage employees to follow all of the company policies and promote operational efficiency and effectiveness. More importantly, internal controls help us as accountants to ensure that the accounting records are reliable and accurate. So internal controls safeguards a company's assets, encourage employees to follow the policies as mandated by the company, promotes operational efficiency and effectiveness, and ensure that the accounting records are accurate and reliable. So U.S. Congress passed SOX, Sarbanes-Oxley Act, and this law was passed that required all public companies meaning that they are traded on some type of national stock exchange, so that means the company issues stock and then you or I can buy them. And what Sarbanes-Oxley did is it told these public companies that they have to maintain a system of internal controls and that the management of the corporation is required to review those internal controls. Public companies have to issue an internal control report, which is normally signed by the CEO, the Chief Executive Officer, and the CFO, the Chief Financial Officer. So those two management C-suite employees attest to the fact that there are internal controls. Now, that is not to say that it's only management that requires internal controls. We also have that the external auditors have to also make an assessment. Usually the external auditors issue an opinion on the internal controls. So any publicly traded company has to have an audit, and it's usually by an independent third-party external auditor, and those external auditors have to state that the financial statements are free of material misstatement, but also that the internal controls are being assessed, and they give an opinion on those internal controls. So now let's discuss the components of internal controls, and there's 5 of them, and it's really easy mnemonic to help us remember crime. So there are control procedures is one of the components of internal controls, risk assessment is another, information systems, the monitoring of the controls, and the control environment. These 5 components are part of COSO, the Committee of Sponsoring Organizations, and they tell us that these are the critical components that need to take place in an internal control. So now let's look at some types of internal controls. The most common is a separation of duties. So this would mean that you separate functions so that there isn't any collusion or any way for employees to try to commit fraud. So for example, if one person records the cash, the other person would take it to the bank. So obviously hiring competent, reliable, and ethical personnel is important, assigning responsibilities, but more importantly, separating those responsibilities will help ensure that the internal controls are functioning as they should. There are limitations, as with anything, and one of those limitations is collusion, right? So if 2 or more employees work together to try to circumvent the internal controls, that will most certainly lead to fraud. Even though internal controls are established to prevent fraud, it isn't 100% foolproof. So now let's shift our attention to the bank account and a bank reconciliation. So let's review some basic information. Cash, we know, is the most liquid asset, right? We list assets in the order of liquidity on the balance sheet, meaning that the most liquid asset is listed first, which is cash, then we might have accounts receivable, and then inventory. So there are internal controls surrounding a bank account. When you establish a bank account, you probably have to sign a signature card, you'll have deposit tickets, and then you have your own routing and account number for your checks. So basically, how a bank account is controlled is based with a check remittance. So when you actually issue a check, here's your routing number and here's the account number, and you want to make sure that you're giving that remittance, telling whomever you're paying, hey, this is what I'm paying for this particular invoice. So a bank statement, now that reports the activity in the customer's account. So, and it's basically used to reconcile. So when we have a bank reconciliation, we take our bank statement and then we reconcile it to our accounting records, or RGL. And some of the items that are used to reconcile these accounts are the canceled checks, those checks that have cleared the bank, and if there's any EFTs, electronic funds transfers, which maybe we didn't record in our books because they hit the bank. So those are the common items on the bank statement that we use to just verify our accounting records. And here you see an example of a bank statement, which I'm sure you're all familiar with, but just to show you what we have total deposits, total withdrawals, any service charges, and our ending balance. So the bank reconciliation, all we're doing here is we're just taking the differences between the cash on our accounting records or our books, and then we're reconciling them to the bank statement. And any differences that arise are usually based on timing, meaning at the point in time when we did our bank reconciliation, usually at the end of the month, maybe these checks didn't clear or this deposit did not go through. So on the bank side of the reconciliation, we have two items mostly: deposits in transit and outstanding checks, right? So on the bank side, we can't really change what's in the bank, so we just put in there, hey, these deposits haven't been hit the bank yet, they haven't been recorded, and these checks are still outstanding. That means the vendors and whomever we issued them to has not cashed it. There also might be, on hopefully rare occasions, an adjustment for some bank errors. So now on the book side, this is our side, our accounting records. So we can actually book debits and credits or through memorandums, which is usually through journal entries. So if you have a credit, you're going to show bank collection. If you have a debit, you're going to show bank payment. You would debit your service charges expense. You would credit your interest revenue. If you have an NSF, non-sufficient funds check, then you would have to show that, meaning that when you tried to cash the check, the person that gave you the check did not have their money in the bank account, so you couldn't get it. And then any type of book. Here is our sample bank reconciliation. Remember that we have on the bank side deposits in transit and outstanding checks, and on the book side we would have any EFTs, electronic fund transfers, any interest revenue that we didn't record, or bank service fees, or any NSF checks. And as you can see on the bank side, we added our deposits in transit and we subtract our outstanding checks. And then on the book side, we add any receipts from customers, cash receipts, and we added revenue, and here we subtracted a payment that we did pay through electronic funds transfer, but we just didn't record it, for our water bill, our service charge, and then we have an NSF check, so it means we recorded the check when we thought we were going to get it from the customer, but now we have to take it out, and we also have to take out any fees associated with that.